Okay, so the topic in this video is break even and cost volume profit analysis. Before we go right into this topic, it is important we define certain terminologies. The first we want to explain here is break even. What is break even? As far as cost accounting is concerned, break even is a situation where we are neither making profit nor making loss. What does this entail? It means that the business person is neither making a profit nor making a loss. Now, what it means is that total revenue or sales is the same as total cost. I come again. Total revenue is the same as total cost. And of course, when total revenue is same as total cost, it means that profit is zero, loss is zero. The business person is merely staying in business afloat. Okay? Mind you, this is a dangerous place to be in business. If you want to remain in if you want to remain in business, it is important your focus is profit. Your focus is profit, and that should drive the business. If you go into business with the intention of staying afloat, if you go into business with the intention of breaking even and remaining so, before you know it, you will start making a loss. So as we go right ahead in this class or in this video, you will clearly see how a business can break even, the formula for break even, and how a business can move from break even position to a profit position. All right. So the second here on the board here is cost volume profit. Okay. Cost volume profit analysis is the analysis of the interrelationship between cost, unit produced or sold, and profit. Again, cost volume profit analysis is the interrelationship between cost, unit produced, and profit. You may want to know what is cost. What do you mean by cost in cost accounting, or as far as this topic is concerned? Cost here is defined as the aggregate of fixed costs and variable costs. Cost is the aggregate or the summation of total fixed cost and total variable cost. What is volume? Volume refers to unit produced or sold. Volume refers to unit produced or sold. Later on in this video, you will get to see how does volume or unit produced or sold interrelate and affect cost. Okay. Now, the last here is profit. What is profit? Profit is simply the relationship between sales and total cost. Again, profit is what? The relationship between sales and total cost. Now, let's also look at relevant. The next thing we are looking at here is relevant formulae. Relevant formulae. We have defined what break-even is. Now, what is the formula for break-even in case you are asked as a student, or in case you want to derive your break-even for your business, all right? What is the relevant formula for break-even? BE is break-even. Break-even, like I said, is a situation in business where you are neither making profit nor making loss. It means your profit is zero, your loss is zero. What is the formula? The formula is simply sales, also known as TR. TR means total revenue, equal to total cost, which is what? TC. Did you see that? Break even means sales equals total cost. That is TR equals total cost. That is total TC. Do you get? All right. Now, if that is clear, you also want to know what is the composition of cost. Cost, like I said earlier, cost is the summation or the addition of total fixed cost and total variable cost. We have it here mathematically: total fixed cost plus total variable cost. Total fixed cost plus total variable cost. This will give us total cost. All right. So the next here will be profit. How do you derive your profit? How do you derive your profit? You know as much as I do that profit is the excess of sales revenue over total cost. Okay, which means sales less total cost. All right, total cost is TC. Profit is what? Sales less total cost. Okay, you want to ask further, how do we derive sales? How do we derive sales? How do we derive sales? Sales is a function of selling price per unit and unit sold. Again, sales is a function of selling price per unit and unit sold. All right, which is price per unit times units sold, which means when you multiply price per unit by unit sold, you'll be getting sales revenue or total sales or total revenue. Okay, so if that is clear, you also want to ask, what is the composition? Okay, we have dealt with total cost, which is total fixed cost plus total variable cost. Perfect. Now, another concept here is the concept of contribution. The concept of contribution. Contribution in cost accounting relates to the portion of sales that is earned after the recovery of variable cost and before the recovery of fixed cost. Okay, mathematically, we say contribution is equal to sales less variable cost. Contribution is equal to sales less variable cost. Again, contribution is equal to sales less variable cost. If this is clear, all right, it means that contribution is derived when you subtract total variable cost from total sales. The excess sales you'll be having is called contribution. Okay, now let's go back to the formula for profit. The formula for profit says profit is sales less total cost. All right, don't forget, we said earlier that total cost is total fixed cost plus total variable cost. I want to do something with this formula for profit. Now, I will bring back this formula for profit. I want to rewrite the formula for profit, which will be profit is equals sales minus, we have total cost to be what? Total fixed cost plus total variable cost. Okay, so I will come here and say bracket open, total fixed cost plus total variable cost. Do you understand? All right, so the first formula for profit here is sales less total cost. Okay, sales is still there in this formula. All right, the minus is still here, while total cost has been broken down into fixed cost plus variable cost. Do you understand? So let's solve further by expanding the bracket. When we expand the bracket, we will have it this way: sales minus total fixed cost minus times plus will give us minus total variable cost. Okay, so if I can rewrite this to make variable cost to come before fixed cost, we have it this way: sales minus total variable cost minus total fixed cost. So this is my second formula of profit. My second formula of profit. All right. This is my second formula of profit. This is just the first formula rewritten. Okay. The first formula rewritten to capture variable cost and fixed cost. Okay. So now again, contribution is what? Sales minus variable cost. If you look at this second formula for profit, I said sales less variable cost less fixed cost. Can you see that? Okay, so the formula for contribution starts from sales to variable cost, which is what we have here. Invariably, we can derive the third formula for profit to be sales, not to be contribution, minus total fixed cost. So this is another formula for profit. Look up. In case you are asked, what is the formula for profit? The formula for profit is simple: sales less total cost. If you want to show skill, you can say profit is further simplified as sales less total variable cost less total fixed cost. If you want to show that yes, you know it, say profit can be further simplified as contribution less total fixed cost. Contribution less total fixed cost. What is this telling us? It's telling us that when you have made sales in your business, deduct variable cost. When you deduct variable cost, what you will be having is called contribution. It is not profit. It is called contribution. All right. You have to now deduct fixed cost from the contribution to arrive at profit. When fixed cost is fully recovered from contribution, you'll be having profit. I hope this is clear. When fixed cost is fully recovered from contribution, you'll be having what we call profit. That is clear. Okay, so again, let your mind go back to the formula for contribution. I said contribution is the portion of sales that is earned after the recovery of variable cost, but before the recovery of fixed cost. Contribution is the recovery of variable cost from sales, but before the recovery of fixed cost. Okay, so that is that. So from the formula of this profit, the third formula of profit, the first formula of profit is this. This is the first formula of profit. The second formula of profit is this. The third formula for profit is this. Okay. While the first formula for contribution is this, which is what? Contribution is sales less variable cost. This is the first formula for contribution. Okay. The second formula for contribution, I can derive it from the formula for profit, from the third formula for profit. Right? So here, profit has been made the subject of the formula here. Okay. So you can change the destiny of this formula to make contribution the subject of the formula. Right? Which will mean that you will say contribution You say is equal to contribution is equal to profit plus total fixed cost. I hope this makes sense to you. Look up. In making this the subject of the formula, it means that contribution is the addition of fixed cost and profit. And that's what we have done here. So from the third formula for profit, we have derived the second formula for contribution. Again, the first formula for contribution is what? Sales less variable cost. The second formula for contribution is profit plus fixed cost. Profit plus fixed cost. I hope this is clear enough. I really hope this is clear enough. All right. So, having done this, you will clearly see that contribution is a function of profit and total fixed cost. Contribution is a function of profit and total fixed cost. Okay, so that is well stated. Now we'll move to the next thing we want to discuss in this topic, and that is the fact that the relationship between units sold and sales revenue and contribution. Okay, we want to look at relationship between unit sold and sales revenue, as well as contribution. What we are saying here is this: what will happen to sales revenue? Don't forget, we said sales revenue also means total revenue. Okay, the aggregate of revenue that comes in, okay, when sales have been made. Aggregate revenue that comes in when sales have been made. Okay, so we are saying that when you sell, what will happen to sales revenue? Will sales revenue increase or reduce? Okay, what will also happen to contribution when you sell? When you sell, what will be the impact on contribution? Will contribution increase or reduce? Please note, as far as this topic is concerned, break-even analysis, as far as this topic is concerned, sales revenue and contribution depend on units sold. Sales revenue and contribution depend on units sold, which imply that the more we sell, the more units sold, the more sales revenue and the more contribution earned. The less units sold, the less sales revenue and the less contribution earned. So we can safely drive at the point that sales revenue and contribution have direct or positive relationship with units sold. Sales revenue and contribution have direct or positive relationship with units sold. Please take note. Positive relationship. Positive or direct relationship. They have direct sales revenue and contribution have direct relationship with units sold. What does that imply in business? What it implies is that For a business person to increase sales, advertisement, sales promotion, marketing cannot be overemphasized. You have to do aggressive marketing so that you sell more. You sell more to drive sales. You sell more to also drive contribution. You sell more to drive sales and to drive contribution. As sales revenue is increasing, contribution too is increasing, because we have said in the definition of contribution that contribution is the portion of sales that is earned after we have fully recovered variable costs. So it means that contribution is also sales, is also a part of sales. So as sales revenue is increasing, contribution likewise is increasing, and vice versa.